Let's look at a whole life insurance policy. And this is just a vanilla walkthrough of what a whole life insurance policy might look like. We'll walk through some of the contractual provisions. I'm doing something that would not make sense with a client, which is going through a product. So, this is a product. This is not showing you the strategy, how it's being utilized for your specific financial situation. So this particular product, I can almost guarantee you, does not make sense for you with this particular design. I'm just showing you an example. And the reason why I oftentimes don't go through specific examples is that it leads people down the wrong path. They assume this is the way of doing it and this is the way it works. No, it's not. It's just an example. And none of these products make any sense until they are contextualized in your overall financial strategy. A whole life insurance policy certainly will not solve all your financial problems. I think they can be great once you understand how it fits into your particular financial life. And usually, as an example, we're going to supplement this with a convertible term life insurance policy. You're also going to have health insurance or health sharing, home and auto insurance, investments, other things in your financial life. This is providing you with many different things. And more importantly, with whole life insurance, what makes it so great is not necessarily what goes on inside the policy, but how it makes everything else about your financial life so much better. A lot of the benefits to this policy or any policy are not to be seen in the policy itself. But let's go through it for what it's worth. And I'm going to jump straight to what's probably the most confusing part, which is the supplemental ledger, just because this presents the most information. Now, I know I've got throwing a lot of numbers at you, and if this makes no sense to you, that's okay. This is an illustration of how the insurance policy works. So in this case, we have Mr. John Smith. He's a male, age 35. He's very healthy because he got approved at the best rating that this particular company offers, Preferred Plus, non tobacco. We're paying an annual premium of $25,000 every year. We're paying $25,000 into the policy. When we pay that first premium, $25,000, we are paying the premium annually. You can pay the premium monthly, quarterly, semi annually. It's up to you. There's a flexibility there, but just to simplify things, we're paying the premium upfront annually. So we pay that $25,000 premium into the policy. When we do that, this is just an example, this is not gospel. We have $16,253 of cash value available to us in year one. And we have a permanent, roughly $1.6 million death benefit. Our family is now protected with life insurance. If John Smith were to die, God forbid, there'd be a $1.6 million death benefit that would pay out. No taxes will be due because it's an insurance claim. And we also have $16,000 of cash value. That cash value is building equity in the policy. You can think of this like a mortgage. $1.6 million is the total value of the house. $25,000 is your mortgage payment, and your cash value is growing equity in the house. Like equity in your house, we can access the cash value. The cash value is what it sounds like. It is cash, which you can use. You can access it by two different ways. You can do a partial surrender, which is like withdrawing money from a savings account. We don't recommend doing that. What you can also do is take out a policy loan, which is a contractually guaranteed right, which means you're borrowing against the policy. And when you do that, the growth in the policy is not interrupted. That can be very powerful because when you use the cash value via a policy loan, you're still earning on every single dollar in the policy. But we're not showing you doing that here. We're just showing the cash value growth. So in year two, you make that same $25,000 premium. Now your cash value grows by $18,000. Your death benefit grows as well. Year three, you make that same $25,000 premium payment. Now your cash value grows by $22,500 in that same year. Your death benefit also grows. And then in year four, you pay that same $25,000 premium, but your cash value grows by $26,800. So by year four, every dollar you pay in premium in the policy gives you more than a dollar of cash value growth. So I just gave you a magic bank account where every dollar you deposit results in more than a dollar of account balance growth. So at this point, we are off to the races. We are cash flow positive in this policy, which is really incredible when you think about it. So, what was the cost? What was the drawback of taking out this policy? Well, it's these negative numbers right here. This was the loss in liquidity that you had to weather, the cost, if you will, of taking out this policy. Over the course of the first 3 years, you had these negatives, this amount that did not go to your cash value. So you had to wait 3 years and you had to pay roughly $17,000. It's actually a little less than that. So you had to wait 3 years and pay $17,000 in costs to now have a bank account where every dollar you deposit results in more than a dollar of cash value growth. Not to mention that $1.6 million permanent death benefit. That death benefit is really important. That death benefit is the asset. It's the asset from which the cash value grows because cash value is the net present value of that future death benefit. And when we take out a policy loan, technically we're borrowing against the death benefit, although you can't borrow out $1.6 million. That would be too good to be true. No, you can only borrow the cash value that you have. Your cash value tells you how much of that death benefit is liquid and accessible. The number one most important element in any whole life insurance policy is the passage of time. These policies age like a fine wine. This is a participating policy with a mutual insurance company, not a stock company, which means that the owners of the mutual company are the policyholders. So when you take out a participating whole life insurance policy with, in this example, Penn Mutual, you become part owner of Penn Mutual and you are now paid a dividend, the same as any other business owner. You participate in the profits of Penn Mutual. So you want Penn Mutual to be profitable. The more profitable they are, the more profitable you are. Your cash value grows in two ways. There's the guaranteed interest rate, which you're being paid. This policy grows at a guaranteed rate. No matter what happens in the market, it is contractually guaranteed that your cash value is going to go up by a certain rate every year. On top of that, you are paid a dividend, and that dividend depends on the profitability of the company. You can see the dividend column here. This is the dividend you're being paid, and that dividend is going into the policy, into your cash value to create a nice compound interest stream. But this isn't all you're being paid. You're also being paid the guaranteed interest rate in addition to that. So notice in year 4, as an example, your cash value grew by $26,800. Of that, 2,933 is the dividend you're being paid. Every year keeps getting better, more cash flow efficiency. The costs are front loaded. So these policies get better every year. If we fast forward to year 10, in year 10, you pay that $25,000 premium and your cash value grows by $38,000 in that same year. No market risk is being taken on here. No taxes are being paid. This is not an investment. Everything here grows based on actuarial math and the profitability of the company. You'll have $286,000 of cash value in the policy. And notice your death benefit has grown, but not as much as the cash value. It's still under 1.6 million in death benefit, but the death benefit does grow. If we fast forward to year 20, John Smith has aged from 35 to 55, so 20 years later, you pay that same $25,000 premium. Your cash value grows by $67,000 in that same year. Your total cash value is $824,000. Keep in mind, we're not taking on any market risk to get this. This is not an investment. It's guaranteed to go up every year. And now we have a $2 million death benefit. That death benefit is important. That is a guaranteed result. That death benefit will be paid because it is a permanent death benefit. And death benefit is the target at which your cash value is aiming. Your cash value will eventually equal your death benefit at maturity, which for policies in the United States is age 121. But really, what happens normally is the death benefit is paid out upon death, unless you live to age 121. Let's fast forward and let's look at year 29. John Smith is now 64 years old. You pay that $25,000 premium. Your cash value grows by $109,000, so more than 4 times what you paid in. You have 1.6 million in cash value. All this grows without paying taxes, without taking on market risk. You could borrow against the policy this whole time via policy loans. And on those policy loans, there are no repayment terms whatsoever. So when you borrow against your policy, you do not have to pay a dime of that policy loan back. Why? First of all, you're borrowing against cash. It's a cash secured loan. So there's no risk of default. We know exactly what you're borrowing against and how much it's worth. It's a guaranteed asset. More importantly, there's a death benefit. So if you never pay a dime of those policy loans back, all that happens is when you die, the death benefit pays off any outstanding loans. It's very simple. There's no risk of default, no credit check, no bank involved. It's a contractually guaranteed right that is given to you by the insurance company. So that is a very powerful tool that you can use. And that's one of the reasons why we recommend using policy loans rather than taking partial surrenders, although you can take partial surrenders. But if you do that, any cash that you surrender is no longer earning for you in the policy. So now you're interrupting that compound interest chain. But you can do that. In fact, there are lots of different options that I'm not showing here. We will go through some of the contract, but honestly, there's no way we can go through every single feature in the contract. Well, I'll show you one contractual right that we have. This is something that I don't recommend that my clients do, but it is good to illustrate to show the flexibility in this policy. What are we doing here? Notice we were paying premiums. Now we're not. Whole life insurance policies can be fully paid up. You can design a policy so that it's fully paid up in whatever length of time you want it to be. It could be what we call a 10 pay, where the policy is paid up in 10 years. You pay premiums for 10 years, and then the policy is fully paid up. You pay no more in premiums, but your cash value and death benefit keep on growing. I don't recommend that because these policies get better every single year. So if you're happy to pay a premium in year one, let's scroll back up to year one. If you're happy to pay a premium in year one where you take a loss of liquidity, where you have less cash value available to you than the premium you paid in, you should be ecstatic to pay that same premium in year 10 where you pay that $25,000 premium and your cash value is growing by $38,000. What about year 20? You pay that $25,000 premium, your cash value is growing by $67,000, more than double what you paid in. I always want to leave my clients at least the ability to pay the premium because that's important. You actually don't have a liability, an obligation to pay the premium. You should want to. It would not be good if you didn't, but it's not required. And that's what I'm showing here. So what we're doing here, this little superscript, is we are exercising a contractual right to take a reduced paid up. We could have kept paying premiums, but we decided not to. So we exercised the reduced paid up option. We tell the insurance company, I want to not pay premiums anymore. The insurance company says, okay. And they reduce your death benefit one time such that your policy is now fully paid up and no future premiums are due, which I would argue is a bad thing. But this is why we don't pay any more premiums. We set up that interest train locomotive and now we can no longer feed it with fuel. So this I would argue is a bad thing, but I like showing the flexibility. It also helps to put the client's mind at ease to know that this is an option. If you're worried about, oh no, how am I going to pay that premium? You don't have to. You can turn it off anytime you want. So notice with the reduced paid up, our death benefit is going up every year until we take that reduced paid up and then it goes down one time. And now no future premiums are due. That's the nuclear option. But your cash value does not go down. It actually goes up because you're not paying a premium, but you're still being paid interest and dividends. So a $1.7 million cash value balance. And now what we're going to do is use this policy for retirement income. The reason why I illustrate the reduced paid up is A, to show the flexibility of the policy, but B, it makes it easier to see what's going on when we take retirement income. So we have less moving parts. If we still had a premium going into the policy, it would make it more difficult to see what's going on. So we reduce the number of moving parts. So now we're going to start taking $72,000 of tax free retirement income out of the policy every year, starting at age 66. So now we're using this policy for retirement income. And we're going to take that $72,000 income stream for 20 years, all the way to age 85, because that's about your natural mortality. So if you were to die at age 85, a $2.9 million death benefit would pay out. Now let's back up a step. So we started with $1.7 million in cash value and a $2.9 million death benefit. Then we took $72,000 of tax free retirement income that we took on no market risk to get over 20 years. So let me pop open my calculator. $72,091 times 20 years equals 1.4 million. So 1.4 million of tax-free retirement income. We got 1.4 million in income out of the policy, but when we're done, we have more cash value than we started with. We started with 1.7 million. We got 1.4 million in income out of the policy, and yet we have $2.1 million almost in cash value. So we have more cash value in the policy than when we started taking income, despite the fact that we've taken all this income. And the death benefit is also higher. It's a little bit higher, 2.93, 2.9 and some change. How did we do that? I'm not going to go into details, but basically, it's the two-dimensional asset that is whole life insurance. Remember, when we take out a policy loan and borrow against our policy, we are not taking any cash out of the policy. That's where this loan balance comes in. See how we have this growing loan balance here? The trick question is, how much cash do we take out of the policy? The answer is zero. Zero. We didn't take any cash out of the policy. Just like if you borrow against your house, the value of your house doesn't go down. And if you're collecting rental income from that house, you keep collecting rental income. This is the same way. So it's like we own this nice $2.9 million property. We start borrowing against the property to the tune of $72,000 a year. We don't pay any taxes on that because it's a loan, not income, not capital gains, but we're still collecting rental income. That's the dividend here. And we're still benefiting from capital appreciation. That's the guaranteed interest rate, which is not shown. So after taking $1.4 million in tax-free retirement income without taking on any market risk, we are left with $2.1 million in cash value and a $2.9 million death benefit, which will now be paid out to our heirs tax-free. That 2.9 million can also be used for long-term care. We'll get into some of those riders later. So if you have a long-term care need or a terminal illness, and with some insurance carriers, even a critical illness like heart attack, stroke, cancer, you can start advancing yourself that death benefit to help pay for your health care. So this is why comparing this to any other asset, especially an investment account, is such a poor comparison. Because if you have $1.7 million in cash value in a seasoned whole life insurance policy, it is so much more powerful than having $1.7 million in, let's say, a retirement account or an investment account, or even in cash or mutual funds or bonds, or really just about any other asset. This is a very unique asset. It's its own asset class. Now, this only happens with a mature policy. You cannot do this in year one in a whole life insurance policy. Because if you think of a compound interest curve, the longer it goes, the better it gets. So this is what you can do with a mature whole life insurance policy. Notice I keep saying a seasoned whole life insurance policy. We've seasoned this policy for 30 years. We could not do this in year one. But if you have $1.7 million in a retirement account, how much income can you get out of it? Do you have access to all of that money at once? Are you going to pay taxes on it? Does it have a leveraged death benefit? Does it cover you for long-term care, etc.? So this 1.7 million that we started with, we were able to get 1.4 million in income out of the policy, and that's net. of taxes, fees, everything else. And when we're done, we still have $2,093,833 in cash value left over. So that's 3.5 million. When you look at this number in cash value, you can mentally double that number because that's about what we got out of the policy. Not 1.7 million, but 3.5 million. It's not even including the death benefit. That's the cash liquid benefits we got out of the policy. So we started with 1.7 million in cash value. We took 1.4 million in tax-free income over the course of 20 years, and we were left with 2.1 million for a total of $3.5 million of cash benefits. Not to mention that $2.9 million death benefit was protecting us the whole time. This is a self-completing plan. If anything happens to you, the insurance company completes your plan by paying out that death benefit to your heirs. So that was going through probably the most confusing part of the policy. Now I want to back up and start going through policy features, contractual provisions, because at the end of the day, whole life insurance is a contract. It is what we call contractual wealth. There are various forms of contractual wealth. There's statement wealth, which is what most average people are used to. It is what it sounds like. You get your 401k statement, you get your Roth IRA statement, and you see on your statement what the current value of your account is. But there are no guarantees associated with it. That account balance can go down, and oftentimes you're severely restricted in accessing what's in that account. This is what we call contractual wealth, which is where wealthy people keep their money. The question to ask is who is absorbing the risk? With statement wealth, you, the customer, are absorbing the risk. Fidelity provides you with the 401k account, but you take on all the risk. If the market goes down, you suffer. Here, the insurance carrier is absorbing the risk, and they are guaranteeing you contractually that your cash value will go up at a certain rate every single year. And we'll get to that later. So let's go back up to the beginning. This is a whole life insurance policy with Penn Mutual. It is designed in a specific way. The designs of whole life insurance policies can vary dramatically, so I never want you to conclude much from seeing this. This is just an example because I can design the policy a lot of different ways, but it'll give you an idea of how whole life insurance works. So just to remind us, we have a guaranteed lifetime death benefit. So the death benefit is guaranteed. It will be paid, and it's lifetime. It protects you for your entire life. Term life insurance is good, but it is temporary. It does not cover you for your entire life. Guaranteed premiums. Your premiums will not go up. No matter what happens to your health, how inflation might be raging, what's going on in the market, your premium level is set. This is unlike term contracts, which are annually renewable, or they're only set for a term. So if you get a 10-year term, your premiums are only set for 10 years. And if you want to keep that policy in force beyond the 10-year mark, your premiums start going up substantially based on the policy payment period. We could have this policy paid up at any point in time. I typically don't like designing policies that way, but you can design a policy to be paid up in one lump sum premium. You can have a single premium whole life insurance policy, or you could pay it up in 10 years, 20 years, 30 years, paid up at age 65. It's really up to you. The policy payment period for this policy is age 100 because that's the maximum this particular carrier will let you do. But we actually paid it up sooner because we took a reduced paid up. So just because you've designed the policy to be paid up at a certain point doesn't mean you cannot pay it up sooner. You also have other options like using cash value to pay premiums. That cash value is like cash. You can use it however you want. You can use it to pay premiums as an example. Predictable cash value growth without market risk. So your cash value is guaranteed to go up at a certain rate and there's no market risk. That's a great peace of mind feature and it eliminates an unknown. It gives you predictability, something that's so important in your financial picture. You may be taking on risk and have uncertainty in some parts of your financial life, like in your investments. And that's fine. But the more you're going to do that, the more you want to make sure you have a safe foundation that is guaranteed, that has predictable and guaranteed results, like whole life insurance. Plus the ability to access cash value for any reason. That's super important. You have the ability to access cash value for any reason. Very important. So you don't have to ask anyone's permission. It's not like borrowing against your house. You don't need a bank's permission. It's a contractually guaranteed right. You can access it anytime for any reason, up to whatever cash value you have available. And then, of course, dividends. That's the only part of this contract that is non guaranteed, is how much of a dividend is going to be paid. Penn Mutual, one of the carriers I work with, has paid dividends every single year straight for over 170 years. Think about that for a minute. That's incredible. So dividends are not guaranteed, but Penn Mutual since 1848 has never missed a dividend payment. And even if they did, your cash value would still be going up at the guaranteed interest rate. But dividends will fluctuate. They go up, they go down. Not dramatically. They tend to be a smooth curve over decades, but they can vary and they're not guaranteed. This is a summary on what we saw before. I do not particularly like rate of return as a measure because it misses so much and it locks us into the Wall Street paradigm. However, this is interesting when you look at what is your internal rate of return on cash value net, meaning totally net of taxes, fees, everything. It ends up being about 5% over 30 years. So you made a 5% net return on your cash value, and that's not accounting for any of the other benefits you're getting, and that's tax free. So that will be at least six, maybe 6.5% if you had it in a savings account, which it might be fair to compare this to a savings account because you're not taking on market risk in a savings account or a money market account. So would you be happy with earning 6 or 6.5% in a savings account? Because after you pay taxes on it on net, you're probably only earning about 5%. That's pretty good. So over 30 years from age 35 to 65, your net IRR on your cash value is more than 5%. That's really impressive. And so you have $1.7 million of cash value and the $2.9 million of death benefit by the time you reach age 65. And then the numbers change because we stop paying premiums. We take that reduced paid up, and so the numbers adjust. Obviously, in year one, our rate of return on the cash value is negative. The costs in whole life insurance are front loaded. The first year is the worst year from a cash value standpoint. It's the best year from a death benefit standpoint. You pay a $25,000 premium, you immediately have a permanent guaranteed future payout of $1.6 million. You get leverage, a leveraged death benefit. You just leveraged your $25,000 into a future guaranteed $1.6 million death benefit on which no taxes will be paid, and you're not taking on any market risk to get it. It's all based on actuarial math. So very powerful. Dividend scale current. The only assumption in these non-guaranteed values is that dividends are paid at the current dividend scale. What are dividends going to be in the future? We don't know. Dividends right now are relatively low because we've been in a relatively low interest rate environment that we're just coming out of. So dividends have gone up a little bit. They're not at the lowest they've ever been, but they are relatively low. So I think that's a conservative assumption. But even if dividends go down, you still get the guaranteed interest rate, which we'll see. Dividend option is paid up additions. We'll get into that later when we get into the complexities of how whole life insurance is designed. So I hope this won't lose you too much. This might get a bit complex. Hopefully, it's not confusing. Let me know if it is confusing. But we're going to keep going through some of the contractual provisions here, which may be too technical for the audience and maybe irrelevant. Please let me know what you think because we are missing the big picture and deliberately getting down in the weeds, which I don't like doing. But I like reminding people that this is a contract at the end of the day. And you have so many guarantees and provisions in here and flexibility that many people may not realize you have in a properly structured dividend paying, participating whole life insurance policy. We'll continue this in the next one.